Good morning and good afternoon. Um, Mr. Jonathan, only three has joined at the moment. Only ourselves are there. Please give me about a few minutes. I'll make an alert in every groups and we'll get some more people to join.
Yeah, I'm not quite sure what's why far south, because there were over 112 registered.
Yeah. Please give me a little time. I'll make an alert for everyone. Thank you. Good afternoon. Thank you for joining another CPD program hosted from Sri Lanka. Good afternoon. Thank you again for joining another CPD program based in Sri Lanka. For today's CPD program, we invite Mr. Malik. He is one of the chartered accountant in Sri Lanka. He is also working for one of the leading finance company in Sri Lanka, LOLC, where his position is manager finance, and he is responsible for preparing consolidated financial statement for the statutory purpose. And before we start today's CPD program, I request Mr. Jonathan Barber, who is the Director International Business Development of Institute of Financial Accountant from UK. I request Mr. Jonathan Barber to express the words regarding today's CPD program.
Farseth, thank you very much indeed for the introduction, and a very warm welcome to everybody who's joining us this afternoon, your time. If it's later, wherever you're joining us, good evening. And if you're also joining maybe from the UK, a good morning to you. It's a pleasure to take part in any CPD session that the Institute run. And I hope you find the coming presentation, talk and discussion of benefit and of use. I'd also like to thank Malik, today's speaker, for his time, effort and energy in presenting and updating members. So thank you to Malik. A couple of things I would mention to all members who join us. You've registered for today's session, so in the politest possible sense, you know where the CPD is found on the Institute's website. There's a lot coming up, and I would please recommend that you keep looking at that and register for appropriate events. The other thing I will mention is renewals of your Institute of Financial Accountants membership. You should have done that by the 31st of December last year. If you've not done so, please will you address that matter urgently. You need to renew by paying A, your membership fee, and B, completing your member return. We have been communicating with all members since early November last year. If there are any issues, I will post my email address and the memberships team email address in the chat facility. Please reach out to us, but now is not the time to ignore those communications or bury your head in the sand. Farsa, thank you for hosting. Thank you again to Malik, and I very much look forward to the forthcoming presentation.
Thank you, Mr. Jonathan Barber, for your advices and guidances throughout the time to do this CPD program successfully in Sri Lanka. And I would like to mention our recent events what we hosted last month. We have conducted a face-to-face event last month. Sorry, the first of this month, and that is regarding AML regulations. And Mr. Richard Sims, who is the director of AMLCC, who has took part and did a training for our members and non-members and students of IFA. And we also hope to have another face-to-face event, hopefully in the month of April. And we would like to bring Sri Lankan leading tax lecturer and the leading tax consultant, who is consulting almost all the leading companies in Sri Lanka. And we would take him for the next face-to-face the workshop. And myself and Mr. Jonathan Barber is working on this. And that event would be hosted in a very grand manner, where the students and members and whoever involved in finance related professions they can join and they can get the benefit of these great events. So we are working on this, and we will be able to give you the more details regarding that upcoming events with you. So be connected with us. And with this information, I request our speaker, Mr. Malik, today to start his presentation. As I introduced him before, he is the manager of finance for LOLC, and his main responsibility is to prepare consolidated financial statement for the statutory purposes. Mr. Malik, I invite you to start your webinar today. Thank you.
Thank you, Farshad. Guys, hope I'm audible to everyone, and hope you guys can see the screen as well. Yeah. So guys, how it works is, first I'm going to take you through the IFRS 16 and little bit of IAS 17, which was the previous standard, the main concepts, right? So thereafter, we'll see how it works actually when it comes to the real world examples. Yeah. Okay. Just to give a quick technical background about IAS 17 and IFRS 16. Let me share you with the Excel document, right? Okay, guys. So as the webinar name mentioned, it is a transition of IAS 17 to IFRS 16. What was the main cause for this? We'll start like this. Guys, some of you might have gone through IAS 17. Some of you might have not gone through IAS 17, right? For the betterment of everyone, just me give a quick briefing on how it works, right? So guys, when it comes to IAS 17, right, which is the previous lease standard, right, it was the previous lease standard. In here, guys, all the lease arrangements or the agreements, we were classified into two categories. They were namely the finance lease and the operating lease, right? So these were the two main leases that we had as per IAS 17. So how do we classify whether it's a finance lease or operating lease? It's based on set of criteria, right? So the main criteria was, the first thing we are asking, with the agreement, whether the risk and reward transfer to lessee or not. So that was the prominent question we are going to ask when we are determining whether this is a finance lease or operating lease, right? Based on the answer for that, if the risk and reward is transferred, we are saying it's a finance lease. If it is not transferring, we are saying okay, it's a operating lease, right? So where the development comes is in this particular area. Why? Because when it comes to the finance leases, it's anywhere recognized in your SOFP, which means statement of financial position, as a asset, as well as the corresponding liability also parked in the SOFP. But guys, when it comes to operating lease, it's more or less charged to a P&L. It's charged to a P&L. It's like expense. That's what happens, right? So when it comes to operating lease, what you simply do, you take the rentals you are going to pay on straight line basis. You are charging it to the P&L. So you debit P&L, you credit cash flow payable. That's it. But guys, when it comes to the analysis of those arrangements, right? If you look at the real substance of those arrangements or the agreements, some of the agreements are there. Yes, true. Based on legality, it's like more or less equal to operating lease. Yeah, it's more or less equal to operating lease, which means right, at the end of the lease term, you won't get the ownership of the asset. Risk and rewards are transferred, blah blah blah. There are there, right? But when it comes to the substance, always when it comes to the accounting, we always look at the substance, right? When it comes to the substance, at the end of the lease term, it will get automatically renewed. Or some of the lease terms are 99 years, right? So you have the option to keep on renewing the agreement again and again and again. So effectively, right? Effectively, even though you are not the legal owner of those lease property, most of the time the lands and the buildings, yeah. When it comes to the substance, you pretend to be the owner, right? Because of that and this and all, there was a development and there were a couple of arguments. If in substance, right? In substance, if it is more or less equal to a finance lease, though you are saying it's operating lease, why don't we recognize this in your balance sheet as an asset and a liability? That was the initial point where these arguments arise, right? So having considered those stuff, what the ISB has done, they have come up with the development to this standard, and that is what we are going to study today, that is IFRS 17. Guys, based on this, right, when it comes to IFRS 17 leases, right, now what we are going to focus, guys, we are not going to ask, look here, what do you call, risk and reward transfer to lessee or not. That's not the question we are going to ask now. Now we have a different approach to recognize whether this agreement contains leases or not. To determine whether this agreement contains leases or not, we have a different approach, right? So we'll quickly go through those stuff and we'll try to figure out how we are going to determine whether this agreement contains leases or not, right? Are we clear on IAS 17? Previously, what I want to highlight, guys, previously, when it comes to IAS 17, there were two types of leases, finance lease and operating lease. How that classification took place based on you are asking whether risk and reward transferred at the end of the lease term. If the answer is yes, you are saying, okay, it's a finance lease. If not, you are saying it's operating lease. And there are some other criteria for you to use to determine whether it's a finance lease or operating lease. If it is a finance lease, no worries, this will be in your balance sheet as a lease liability as well as a lease asset as per the previous standard. If it's operating lease, this will be in your P&L as a expense. Clear? So then the problem is there are some of the agreements, yeah, as I said, there are some of the agreements in substance, those are like finance lease, but because of the standard, we are recognizing those stuff in the P&L, because as per the standard, we have to park it in the P&L. In real terms, we have an option, we have an ability to take it to the balance sheet, right? So that was the problem. Then, as a solution and a development in other areas, they have come up with another standard. Another standard means updated version of leases, that is IFRS 7. Clear, guys? Right. So here the leases. I hope everyone aware of what the lease arrangement is. Yeah, I believe everyone is aware what the lease arrangement is, guys. When it comes to a lease, it's very simple arrangement, right? Just to make a complicated area, just to make your life easy, let me quickly go through what this arrangement is. Suppose, guys, you have two parties, A and B. So normally, what will happen in a lease arrangement, right? What will happen in a lease arrangement? A party called A or whatever, right? One particular party transfer the right of using an asset, right? One particular party will transfer the right of using the asset to another party, right? So suppose A is the owner of the land, and what A is doing, A is telling to B, okay, you use my land, never mind, for this number of years, right? In return, you have to pay me this much per month. Simple arrangement, right? So A is doing what? A is transferring the right of using that asset, right? What A is doing? A is transferring the right of using the asset to B, to the other party. Is it free of charge? No, never, right? We won't run business to make losses. Oh, we are not running the businesses for a charity purpose. Therefore, what they is saying, okay, you use the asset, and he's specifying you can use it only for this number of months or years, right? You have to be specific all the time, right? You have to be specific all the time. A is saying, okay, use the asset for 5 years. No worries, I will give you the right to use the asset for 5 years. In return, what the B has to do? B has to pay what? The monthly payment, maybe annual payment, right? That is based on the arrangement you are going to make, right? Maybe annual, maybe monthly, right? What the B has to do? B has to pay a periodic payment, right? Periodic payment, right? Right. So guys, as I said, here I have mentioned three, four important terms. Number one, guys, this entire arrangement is what you call it as a lease, right? This is what you call it as a lease arrangement. But the point, one party transfer the right of using an asset to another party for a specific period, which is subject to what? Periodic payments. Are we clear, guys? This is called leases, right? Then another important term, guys, the party who's transferring is called lessor. Party who's transferring the right, we call it as lessor. Party who's getting, we call it as lessee. Then guys, what about this specific period? Guys, that is called your lease term. That is called your lease term. Then what about this periodic payments? Guys, that is called lease installments. I'm pretty sure you might have heard all these terms, and these are the meanings of that, right? So if somebody asks what do you mean by lease, you should be able to tell it. This lease is this kind of arrangement, and these are the important terms involving in a lease. Clear? Right. We are clear on it. The next one, when it comes to this particular standard, guys, you have to look at from two angles, right? One is called lessee, from lessee's point of view. In other words, in the books of lessee, how do you recognize leases in the books of lessee? The other one is lessor, person who is giving the right. You should be able to recognize these arrangements in the books of lessor. Guys, in this webinar, I'm focusing on this particular part, lessee, right? So most of the time, the struggle comes, most of the changes needs to take place in the lessee's books. Clear? Therefore, I'm going to focus on lessee's side, right? Okay, guys, then when it comes to lessee, the first thing you have to ask, not like those days, first question would be whether the agreement contain leases, right? So normally when you guys enter into a lease agreement, right, you just go and check whether that agreement contain leases, right? Saying it's a lease agreement is not sufficient for you to recognize it as a lease asset and a lease liability, right? I'm not going to use the technical words, right? I will use it later, right? You need to check whether that agreement contains a lease or not, right? So how do you do, guys? You have to ask three questions. You have to ask three questions. What are those? Number one, guys, you have to check. You have to go through the agreement and see whether identifiable asset is there. That means a specific asset which is assigned only for that agreement. That means lessor does not have any right to change the asset time to time. Clear? That is called identifiable asset. It is specifically assigned for you only, right? Lessor cannot change time to time. Then number two, you're asking the question. Answer might be 2. Yes, no. Correct? Keep that in mind, right? Then the next one, right to direct. In simple terms, do have the ability to control the asset, right? Which means if it is a land, can you build up a factory there? Do you have the right to decide it? If you want, can you rent out the land to somebody else? If you want, can you build up a wall around the land? do you have the controllability? Whether you have the right to control the asset. That's called the right to debate. Then third one, substantial benefits. Whether the benefits generated from such an asset is substantially enjoyed by lessee or not. Right? Which means if there's a capital appreciation, who is getting the benefit? If it is rented out to somebody, who is getting the benefit? Yeah. So those are the 3 questions you have to ask when it comes to a lease agreement. Based on the answer, you can conclude whether the agreement contains leases or not. How? Guys, if the answer for all these 3 questions, right? If the answer for all these 3 questions is yes, right? If answer for all these 3 questions is yes, then guys, you can conclude as what? You can say this agreement contains leases. Guys, I'm repeating it. Answer for all these 3 questions should be yes to conclude as agreement contain leases. To conclude, agreement contain leases. Are we clear, guys? All the questions should be yes, yes, yes. Right. What if the answer is no? Very simple, straightforward. Then you can say does not control leases. That's it. Right? Nothing to worry. If one of the question get the answer as no, then your conclusion should be what? Agreement doesn't contain leases. Then what you are going to do? That's very simple. Right? In a situation where agreement does not contain leases, or some of the lease agreements are there, you are getting yes for all these 3 questions. But those lease terms are for lesser period. That means some of the lease terms are for 10 months, right? Some of the agreements are there, those are lower value agreements, which means compared to the other lease agreements, your normal lease agreements are in millions and billions, right? But you come across an agreement where the lease value is 50,000, 60,000. It's a lower value, right? It's a lower value. Where all the criteria are met, but due to short term and lower value, standard has given you a exemption. If you want, you don't need to recognize it as a lease. Rather, what you can do, you can claim exemption from what? Leases. Exemption from leases. Then what the benefit you are getting? Guys, you don't need to go through a heavy workload, right? No need to recognize lease assets, lease liabilities, amortizations, no nothing. You can just claim exemption, which means what? 2 scenarios, guys. When the answer for all these 3 questions are no, or answer is yes, but you are claiming exemptions. You are claiming exemptions by saying it's a lower value or a short-term lease compared to the other. Then, guys, what the standard says, very simply, standard says you can charge it to PNL. You can charge it to PNL. Then the workload is very minimal. No need to put an extra effort to recognize that agreement and this asset, that asset. No. Clear, guys? Right. Okay. So hope you got an idea how we are going to recognize the leases. Yeah. Right. Now, again, we are narrow down our scope. Again, we are not going to look at this area. We are going to look at this area. Right. Now, you conclude as, okay, agreement contain leases. Right. You have concluded, okay, agreement contain leases. Then the problem comes. Why? Oh, measurement. Right. Measurement. Now, you have to measure. Right. What? 2 things. One is called, previously it is called, guys, lease asset. But that name is no more there. Now we are saying right of use asset. That is the new word. Right of use asset. Yeah. Right of use asset. You should be able to measure right of use asset. Number 2, you should be able to measure the lease liability. lease liability. How it works. We'll see. Let me start off with the lease liability. Guys, when it comes to the lease liability, how do you recognize the value or how do you measure the lease liability? It's straightforward, right? Straightforward. Very simply saying, I could say, amount you are paying as lease installment. Amount you are paying as lease installment, maybe per month or maybe annually, maybe monthly or maybe annually. Take the present value of those. Take the present value of those payments. Understood? Take the present value of those terms. That is equal to your lease liability. Very simple, right? This is basic financial management, right? You take the present value of future cash flows. That is equal to the lease liability. Are we clear? Right. So when it comes to the lease installment, it consists with different components, right? So for your easiness, I will put it down like this, right? Guys, you might come across a scenario where there's a fixed payment, right? If you go through a lease agreement, you might see, okay, 100,000 per month, 150,000 per month. That is called the fixed payment. In some of the agreements, they might add variable payments as well, right? 100,000 plus 1% of your sales can be, right? Then guaranteed residual value. So you guys know what I mean by residual value. That is the value you can have it at the end of the lease term, right? So that needs to be taken. Then exercise options. In some of the agreements are there, guys. They are coming up with options, right? That means to extend, right? You have the option to extend the agreement. Termination option means after a certain time, you have the option to terminate the agreement, right? In those scenarios, you might have to do some payments. Take all those payments, present value, that is equal to your lease liability, right? So that's what the standard says. So why did I first started off with lease liability? Because that will help for me to measure the right of use asset, right? So guys, when it comes to the right of use asset, so how do you measure? Again, it consists with a couple of components. What are those? So the major component, right? The major component included there is present value of your lease liability. Very simple, right? That is the present value of the lease liability. That's why I started off with this, right? So that's why I started off with calculating the lease liability. So once you are done, that is the figure you have to take it here. On top of that, any down payment if you made, you have to consider it. Any direct cost, that means stamp duty, legal fees, any other payment which is directly involving the agreement, you have to consider it. Dismantling and decommissioning costs, these are future site preparation as well as asset removal costs, right? If there's any, you have to take the present value of those and you have to plug in to the right of use asset value, right? So this is how you need to calculate the right of use asset. Are we clear, guys? Right. So the next one, guys, when it comes to the right of use asset, one of the point to be noted is how to do the calculation of depreciation and amortization, right? So you know depreciation or the amortization is a very straightforward exercise. What you are supposed to do, you take the value, you divide by useful lifetime. That is going to be your depreciation or amortization for the period. But guys, when it comes to the lease, you should be extra careful and you have to ask the question whether you are getting the ownership of the asset at the end of the lease term. Whether you are getting the ownership of the asset at the end of the lease term. You have to ask it, right? Based on that, right? You're asking ownership is getting or not. Based on that, you have to use a different base. Ownership, two things, transferred, not transferred. Guys, if the ownership is transferred, that means even after the lease term, you are going to use this asset forever. Forever in the sense, till the end of economic lifetime. Since the ownership is transferred, guys, the base should be useful lifetime. For depreciation calculation, base should be what? Useful lifetime. If it is not transferred, guys, at the end of the lease term, you are not getting the ownership. If that is the case, that is the place where you need to be careful. you have to check what is the useful lifetime of the asset and what is the lease term of the asset. Based on that, you need to take the what? You need to take the lower value. You are supposed to take the lower value. Are we clear, guys? You are supposed to take the lower value. Out of these two, you need to take the lower value. So that is what you need to keep it in your mind when it comes to the right of use asset. Because when it comes to lease liability, what is important for you is the classification, right? So you know this is you are doing for your loans as well. When it comes to the classification, the lease liability needs to be split between current and the non-current, current and the non-current. So that needs to be kept in your mind, right, guys? So that's the basic stuff for the logics and the rationale behind and the technical guidance for you need to understand before you are going to the application of SLFRS or IFRS 16. Yeah, right. So guys, I'm not going to look at the lessor side, right? I'm not going to look at the lessor side, but for your knowledge purpose and the future reference, I will update here the areas you need to expertise, right? These are the things you need to keep in mind when it comes to the lessor, right? Lessor in the sense the party who is transferring the right. Just to go through this particular area I have mentioned, right? But our main focus is on the leasing, right? Guys, so that's all about the technical stuff we are required in order to understand the real example, right? Okay, guys, now let me take you to the real example, how that we in the sense that Sri Lanka has implemented IFRS 17. Basically here when it comes to Sri Lanka, it's SLFRS 17. Sorry guys, 16, my bad. IFRS 16, right? How this IFRS 16 has been implemented here, right? So just another quick point, guys. So this comes into effect on with the effect from 1st Jan 2019, right? So IFRS 16 replaces IAS 17 on 1st Jan 2019. So the financial year which ends on 31st March 2019, right, has the impact of this IFRS 16, and the entities had to do different arrangements in their books of accounts in order to adapt to IFRS 16. All those transition provisions has been mentioned in the standard, but let me take you through an example, then you can understand what are the changes that we had to incorporate in our books, as well as subsequent to the change, how it works now, right? Okay, so let me take to the real world example, guys. This is the adoption of IFRS 16 for the first time. Yeah, right. So basically, this is the company that I have involved in implementing IFRS 16 for the first time when it comes into the effect. So this is actually a company which is a limited liability company which is incorporated in Sri Lanka, and their principal activity is catering business. This is a catering business, and they are catering to the airlines, right? The world leading airlines. And through this presentation, through this slideshow, my objective is to show you how the application of IFRS 16 to the lands. It is basically to the lands. Just to give a brief background, what the issue is, guys. They are mainly, I would say, their factory was constructed in a BOI agreement, right? Under a lease agreement, right? Under a lease agreement. So before this IFRS 16 comes into play, the payments you are making to this land as lease payment was recognized to P&L as an expense. You debit P&L and you credit your cash or bank or the payable accounts, right? So with the introduction of IFRS 16, guys, we have to start from the beginning and we have to evaluate the lease agreement in order to determine whether this particular agreement contains leases or not, right? So accordingly, we have gone through that agreement and we try to figure out answers for these three questions as we discussed previously, right? Whether there's identifiable asset, whether they have the right to direct it, whether they have the substantial benefits, right? Then what we conclude, guys, yes, the answer for all these questions are yes. Therefore, we conclude yes, this agreement contains leases. Now, what you are going to do? You need to do the accounting treatment to look, right? To make your books, you have recognized this particular asset from the day one, right? Which means retrospective application. So we had to do a retrospective application because that was the transition provision given in IFRS 16, right? Retrospective application is the treatment, right? So you have to go back to the past and you have to correct it, right? So we'll see how it corrected, right? Then we recognize the lease term, guys. When it comes to lease term, just for your understanding, there is normally when it comes to a lease term, there can be a definitely there is a non-cancelable period. On top of that, some of the agreements you might have extension period, some of the agreements you might have termination, right? It's not hard and fast rule to have all these three, right? So this will be the component that can be seen in each and every agreement. The other two might be there, might not be there, right? Then our task was to incorporate the right of use asset in the balance sheet as well as lease liability in the balance sheet, right? Right, guys. So our exercise was started with this, recognizing the lease liability, then ROU, then we went to the subsequent measurement, right? So how it works, guys? Guys, this is the brief computation, right? Even though I am saying this in this kind of a simple manner, it's not actually a simple task, right? It was a cumbersome process because you have to go through the agreement, you have to read it, you have to argue, you have to prefer the standard, then you have to check whether what the treatment is, you have to consult your expertise, your seniors, everything, right? So behind this, there's a cumbersome process. But now I'm presenting you in a very straightforward manner, right? Because now we have done it a couple of times and now we know how it works and that and all, right? Okay, guys, just to give a brief introduction to the agreement, right? It's mentioned here, guys. This includes 625 monthly installment. This agreement is for 52 years. Yeah, 52-year agreement, and this starts on 2004. This agreement started on 2004 and it's on 2056. Still, this is going on, right? Okay, then as I said, guys, in order to identify the right of use asset, I told you it's better for you to calculate the lease liability first. It's better for you to calculate the lease liability first, right? So accordingly, guys, what we did, right? Accordingly, guys, what we did, we have prepared a very simple present value calculation table. Very simple present value calculation table. So I hope everyone is aware what do you mean by present value and how do you calculate present values, right? So starting from 2004, guys, right, we bring it to 2056. All the lease rentals to one sheet, right? We wrote all the lease rentals. Then what we did simply, we have computed the discounting factor, right? You know, when it comes to the financial management, you know how to calculate the discounting factor, right? So in this particular standard, it says if the discounting factor is not explicitly available, what you can do is you can take you can get the incremental borrowing rate. So accordingly, this particular entity has done what? They have taken the incremental borrowing rate as 14.34, right? And using that particular rate, we have discounted all the cash flows and we got the present value. We got the present value of all the payments. We got the present value of all the payments, right? Right. So after that, we got a figure as 71 million 0.5, right? 71.5 million as the lease liability value. Lease liability value. So that is the starting point, and that is the value for both, right? So that was the value for both liability as well as for the asset. Why? Because when it comes to the right of use asset, I told you there are a couple of what? There are a couple of components: lease liability, down payment, direct cost, dismantling and decommissioning. But as for this particular agreement, there was no down payments. Yeah. Then there were no direct cost, as well as there were no dismantling or decommissioning cost. Therefore, what happened? Your lease liability equals the right of use asset at the beginning, right? Okay. Then after that, what you have to do, guys, very simple thing. You have to prepare your lease amortization schedule, right? Like you are preparing for the loan amortization, you have to prepare the lease amortization schedule, right? Why is that? Because you need to do a subsequent measurement, right? Initial, it's not enough for you to recognize ROU as well as lease liability for the initial, and you can't keep those figures as it is and continue. No, you can't. So what you have to do, guys, you have to right? What you have to do, you have to do the initial measurement, that is this, yeah, lease liability 71.5 million as well as right of use asset 71.5 million. Subsequently, you have to recognize this, right? Amortized cost, right? Your lease liability needs to be recognized at the amortized cost. Clear? In order to recognize that, guys, what we did this lengthy computation, right? So as I said, guys, this particular standard came into effect on 1st Jan 2019, right? So what we did, guys, we have implemented or we have adopted SLFRS or IFRS 16 for the first time for the financial year 19 and 20, which means starting on 1st April 19, ends on 31st March 2020. That is the first financial year that we have implemented this IFRS 16, right? So that lengthy computation we have classified like this: up to March 2019, what are the values? Then during the period, what are the values? After that, what it is. Why is that? Because, guys, as I told you, you are supposed to, right? You are supposed to adjust your books retrospectively, right? What do you mean by retrospectively? You have to make your books as this IFRS 16 was there since 2004, right? You are going to make your books like, okay, we have applied IFRS 16 from 2004. You are going to make your books like that. In order to do that, we need this classification, right? Then what we did, guys, we did the basic set of double entries. So now tell me, what? Tell me the sense, now think, right? So far in the sense, since 1st April 2019, these entities has charged the rentals to the P&L. Everyone agree on that, no? Right? Because since 1st April 2019, there was nothing called IFRS 16. Therefore, whatever the lease installments that they are paying, they charge it to P&L. That's it. Now, what we are going to do? We are going to reverse it back. We need to reverse it back. Agree? Right? We need to reverse it back and correct it. Right? So, how we are going to do that? How we are going to do that? So, those are the simple stuff you have to do. Right? Okay. Then, to make your life easy, let me split the double entries in this manner, right? So guys, here it's just a quick summary of the agreement, right? You can go through these stuff leisurely, right? These were the set of journal entries that we had to pass in the books in order to adjust your books retrospectively, right? So first thing, guys, we did is what? We need to recognize lease, liability, and right of use asset. Right of use asset, guys, this is the one. Right of use asset, it's 71.5 million. That is the present value of your lease liability. Can you remember? Right, that is debit, lease liability credit. Clear? Done. Simple, straightforward. Right, now think, now you have an asset. Since you have an asset, you need to do what? Can you remember? Depreciation, or in other words, amortization. Now you have to calculate two types of amortization. What is that? Two types of, guys, why? For the prior period, that means on or before 1st April 2019. Before that, what is the depreciation amount? Then for the period, or for the current period in the sense, year in which you are going to apply it for the first time. That means for the year which ends on 31st March 20, what is the depreciation? You have to split it. So how do you calculate it? It's not a big deal, right? So this is the amortization. Up until 31st March 2019, the depreciation amount 21.3 million. Guys, that needs to be passed how? You debit retained earnings. Why? This is for the prior period. Retained earnings debit, accumulated depreciation credit. Are we clear, guys? Yeah. You debit retained earnings, credit, accumulated depreciation. Done. Then up to 31st March 2019, whatever the lease rentals paid, which means 150. These are in where? In the P&L. Now you need to take it back. So P&L credit. Can you credit P&L? No. P&L items now parked in retained earnings. Therefore, retained earnings credit. Yeah. Retained earnings credit. Rentals paid. Retained earnings credit. Where to debit? It is the lease liability settlement. To debit lease creditor. Correct, right? Lease creditor debit. Then these lease installment consist with two components. What are those? Interest and capital. Can you debit both interest and capital to the lease creditor? No way. You need to debit only the capital portion, right? So here you have credit both interest as well as the capital. Therefore, please credit the capital portion again to the lease creditor. How do you do? So if you go back to the lease amortization schedule, here it gives you the interest for the prior periods. How much? 284 million. 284 million. That needs to be credited to the lease creditor and charged to where? Charged to retained earning. It's a prior period expense. It's a prior period expense. To credit lease creditor, you debit retained earnings. That's it. That's called the prior period entries, right? Now you have make your books like IFRS 16 goes from the beginning, like in 2004. Now your books like you have applied this from since 2004. You have make it like that. Now it's just a matter of you are passing the current period entries. Now it's just a matter of simple mathematics. Depreciation for the period, normal double entries. You debit P&L, credit amortization. Very simple, straightforward. During the period, whatever the rentals you paid, you debit lease creditor, credit where? Credit retained earnings. Why it is retained earnings? Retained earnings or the P&L, right? Retained earnings or the P&L. Wait, guys. Let me write it as P&L. Then it's easy. It's easy in the sense that should be the right wording. Okay. So current period at the moment you have debited the P&L. Yeah. Therefore, you are crediting it. rentals paid. Yeah, you credit P&L, you debit lease creditor. Then the interest for the current period, you debit what? You debit P&L, current period expenditure, you debit P&L, credit lease creditor. That's it. Are we clear, guys? So those are the simple. So after the 1st April, so once you are done with this first time adoption entries, thereafter it's just a matter of you passing these 3 entries continuously up until the end of the agreement. Depreciation, rental paid, then the interest portion. Straightforward. Clear? So that's what you have to do. Guys, then actually what was the benefit comes because of IFRS 16. So that is also required to understand. As per IAS 17, guys, this particular entity has not recognized any asset or liability with regards to this particular agreement. Understood? As per IAS 17, this particular entity has not recognized any asset or liability in your balance sheet. If I'm not mistaken, right? Hope you all are aware of conceptual framework. In the conceptual framework, there's a particular area called qualitative characteristics. In that qualitative characteristics, we have fundamental characteristics as what? Relevance and faithful representation. Yeah. So which means when you are providing the information to the financial statement readers, it should always be relevant as well as faithfully presented. Right? So in substance, this agreement, right? In substance, you are like the owner of this particular asset, but you have not recognized it in your balance sheet. Also, you have not recognized the respective liability for that asset in your balance sheet, which means you have not complied with fundamental qualitative characteristics of the financial information, right? Since you have adopted IFRS 16, now you are complying with what? Relevance and faithful representation. Relevance and faithful representation. Now your asset base as well as liability base has what? Has increased and giving the real picture of the business. On top of that, previously the entire amount charged to P&L because the payment is fully charged to P&L, but now that payment split between interest parties in the P&L, parties in the balance sheet. On top of that, a new expense is recognizing, that is what? Amortization. It was not there previously, now you are recognizing. Clear? So guys, those were the changes that took place when you were changing, when you were moved out from IAS 17 and adopted IFRS 16, right? So basically, because of this adoption, now your financial statements are more relevant and more faithfully presented compared to the previous, right, guys? So those were the changes, and this is the computation. And I hope most of the organizations, right, locally, internationally, most of the organizations, you might have come across these arrangements, right? So when you get this kind of arrangement, still some of the organizations are there. They have recognized their agreements in an incorrect manner, right? If you come across that kind of if you are auditor or if you are the accountant or finance manager of the company, whoever, right, attached to the finance, if you come across a lease agreement, please go through it carefully and try to figure out the answers to those 3 questions and check whether you are applying the right accounting treatment, for those agreements. Otherwise, what you have to do, you have to pre-compute these figures, and you need to apply this kind of a treatment, right? For the previous years, apply this kind of thing, and for the current year, you have to apply these kind of things in these 3 entities, right? So this needs to be done in order to ensure your financial statements are relevant as well as faithfully presented to your stakeholders. Right, guys? So that's basically the IFRS 16, and that is what actually I have to share with you. when it comes to this transition from IFRS 16 to from IAS 17 to IFRS 16, and hope you guys got some kind of understanding what was the changes as a result of this adoption, what was the development to the balance sheet and all. Right, guys. So okay, that is from my end. Right, now it's up to you. If you have any clarifications, anything other than the things that I have mentioned, you can ask it. Then I can answer whatever the questions you all are going to ask. Yes, guys, it's up to you. Any questions, you can raise it.
Malik, thank you very much indeed for a very detailed talk and interactive presentation. Most grateful for that. Thank you very much indeed. We have a particular attendee who's thanked you. The question's been raised, are we going to receive the recording and the spreadsheet documents? Well, I can explain that early next week, those that have attended will receive a recording. That will obviously show you as you're working through it the spreadsheet examples that Malik has used. I've also been asked the questions, can I get this PDF or Word file? No, you'll get a recording of the session.
Yes, I will share all these documents with what you call with this with Farshad. Then you guys can get it from him. So it's not a big deal.
Yeah. Okay. So again, another thank you to you, Malik, for your time and for the presentation. Somebody's asking about a CPD certification. If you're a member of the Institute, you are able to update your CPD records, and you should do that as a matter of course when you've attended and you've undertaken CPD. If you're after a particular certificate, you would need to contact the events team at the Institute, explaining which event you attended. That would then be verified, and yes, a certificate could be sent to you. But it's very much your responsibility to update your own CPD as a member on your dashboard. Malik, there was a question here, why rental paid is credited? Oh, I think you might be typing an answer, actually, sorry.
Yes, so guys, why we are crediting the rentals paid? So as I said, right, so as per previous standard, this is just an expense to charge to P&L. Since you are moving out from that and now you have recognized a liability, right? So the rental paid is like what? The settlement of the liability, right? So settlement of the liability, you need to debit to the lease creditor or the lease liability. And where's the credit entry at the moment? It's in the P&L. Yeah. So at the moment, you have to debit it to the lease creditor, but you have debited it to the P&L as per the previous standard. So now what you are doing, you are taking out from there, right? Therefore, you credit P&L and you put it into the lease credit. That's why we credit it.
Malik, thank you for that. A further question. What functionality does the company's ERP system have with regard to IFRS 16?
What do you mean by the functionality? I mean, you might asking what kind of development needs to be done in the system, right? So in your accounting system and all. I guess that is what you are meaning.
Yeah, sorry,
right,
I'm reading out the question. So the person who maybe has asked that question, I think you can understand from Malik's response, maybe a little bit more information and clarity is needed so that he can effectively answer your question. Your question as it stands is too vague to be answered. So please do provide a little bit more information so that you get the answer or the information you could be looking for. Are there any other questions for Malik? Malik, before I hand back to Farseth, just to sort of conclude and wrap up, thank you very much indeed, as I said, for a very good presentation. So we have got a further question. Malik, what is the treatment in the end of the contract period?
What is the treatment in the end of the contract period? So at the end of the contract period, what will happen, guys? Your right of use asset is fully depreciated and your liability is zero, right? Your liability will get settled. That is more or less equal to you obtaining a loan from the bank. At the end of the loan term, your liability will be zeroized. Similarly, in here also your liability will get zeroized. On the other hand, the right of use asset will get fully depreciated. Implicit interest rate, guys. Implicit interest rate means if the interest rate with regards to the lease agreement is not mentioned in the agreement, right? Not mentioned in the agreement, what you have to do, guys, you have to calculate the interest by looking at what? So I hope when it comes to FM, you might have heard IRR, right? Internal rate of return. That is one way of you can use to calculate the implicit interest rate. Or else what the most of the entities they do is they are taking the incremental borrowing rates. That means if you are going to buy a loan from the financial institute at the moment, what would be the rate they are offering to you, right? So you can use that rate as well.
Thank you, Malik. We've got another question. Explain a bit about implicit interest rate.
When it comes to a lease agreement, if the lease receive rental contract on fixed basis for 5 years, is there any rule for PVO as a lease we have to? Because no, guys. Here, get the idea. Here, when it comes to a lease liability computation, we don't mind whether they are paying it monthly, quarterly, semi-annually, or is it for entire 5 years at once. But what you have to understand, guys, is when you are computing the lease liability, always make sure you take the present value of it. That's it, right? It may be fixed for 5 years, it may be fixed for 10 years. Never mind. You take the cash flows monthly or yearly or whatever, discount it and take the present value. That's what you have to keep it in mind. That is the value which is equal to the lease liability.
Malik, thank you very much indeed. Farseth, I'll hand back to you, but please to any members who are on this presentation, on this webinar, who've enjoyed and probably benefited from the last hour and 10 minutes of Malik's talk. If you haven't yet renewed your membership, please do so as a matter of urgency. I've posted my email address within the chat facility. It is now very much your responsibility to act. Farseth, I'll come back to you. Thank you.
Thank you, Mr. Jonathan, and thank you, Mr. Malik, for your wonderful explanations about the standards, which is really indeed for today's discussions. And I especially thank Mr. Jonathan for arranging today's safety program, for your all kind of supports and guidance to have these in a great manner. And Mr. Malik has been a busy person and he's a lecturer for chartered students, but he has allocated his valuable time today with us, accepting our invitations to be a speaker. So I wholeheartedly thank you on behalf of the IFA, and thank you for your wonderful explanation today. And dear members and students, and we hope to have another CPT program with the different topics. So keep connected. We will be informing you. And next face-to-face event is about tax related workshops, which will be face-to-face, and be connected. We will be giving you the record information. So having said that, I thank you everyone who took part in today's CPT program. Have a good day. Thank you. Bye.